Well, I'm back. We are here to talk about the second quarter investment markets. This is our investment review and outlook. We try to do every quarter, and here we are. It's July 13th, and just talking about what happened for the first half of the year and also what to look ahead for the second half. So I'm going to jump right into our slide deck. If you want to get a copy of this or want to talk to me about anything else in more detail, just let me know, and we are happy to schedule a meeting. So let's jump right in to our deck. Okay, let's just jump into our themes and topics for today. So we have 6 that we're going to walk through with a few different charts in between. So first and foremost, we want to talk about the investment performance in the second quarter, and then also compare first quarter to second quarter and just see what trends and what differences are going on. We also want to talk about Nvidia exposure. Nvidia has been in the news a lot, and so I've had some client questions and just want to kind of address where we are with your exposure to that stock. As we look ahead, I'm going to argue that stocks are priced for perfection. That doesn't mean that things have to go bad, but we need to be aware of the risks that are not priced into the market. Then we're going to talk briefly about how the US dollar affects future returns. And then want to lastly talk about what is very likely to be the beginning stages of a commodity supercycle and what that means for investors. So let's jump in to just looking at performance. So this is a chart that looks at all the major indices. So I'm just going to quickly walk through what these symbols mean. I think it's important to show an actual fund that you can own as opposed to an index, because you can't actually buy an index, but you can buy a fund. So these are all ETFs that you can go out and buy that are tracking different areas of the market. So we start with the QQQs, the best performer for the second quarter. And again, this is from April 30th to April 1st to June 30th, 2024. So we start with QQQ, which is the NASDAQ. It's mostly tech stocks. Then SPY is in purple. That is the S&P 500, the largest 500 companies in the US. IWM, it does not stand for Illuminate Wealth Management. It's actually the Russell 2000 Index, which is small cap stocks. Then we have BND, which is the Vanguard Bond Index. So this is just how bonds did overall. VTI is a ticker symbol for the total international market. Then VWO is emerging markets. GLD is gold. DBC is commodities as a whole. And then VNQ, that is your real estate. So as you can see at the top, for the second quarter, the Qs, again, did really, really well. That's tech stocks led the way, up almost 8%. On the laggard side, we have the Russell 2000 small cap stocks did not do well, and that unfortunately has continued a trend that's gone on for most of the last 15 years, although we do have a number of years that small cap outperformed large cap. When large cap has done well, small cap has not kept up in general, and so that's something we're definitely aware of and going to continue to watch. You can see the second best performer, though, is VWO, which is emerging markets. So that's a nice addition to the portfolio. We have emerging market stocks. We have international stocks. They've held up even when small cap has not done as well. And then you can see that for the second quarter, gold was up a decent amount. Bonds were pretty flat, and commodities were flat overall. So this is a good performance overall, and pretty much everything you invested in did okay, or if you were invested in the NASDAQ stocks, did pretty well. That is a fund, the QQQ, that we added at the beginning of the year, 2 portfolios, and that's held up pretty well. As we look to the S&P 500, I just want to zoom in on the largest 500 companies and look at different sectors. So this is a chart looking at sector returns. And at the top, we have information technology. That's got companies like Apple, Microsoft, Nvidia are all in information technology. That sector itself was up 20% for the second quarter. On the downside, energy stocks did not do that well, actually lost money in the second quarter of this year. So as we look at all the different sectors, you can see what's leading the way, and that's honestly kind of continued a trend that we saw last year. And so as we look, though, at the first quarter compared to second quarter, there really were 2 different it's a tale of two quarters, as I say. So in the first, I just pulled out one area that I think a lot of people look at from a value stock perspective or a defensive stock perspective, and that's financials. So XLF is the financial sector, SPY is just the overall index, and then QQQ, again, is technology. As we look here in the first quarter, you can see that actually financials led the way. So value stocks did really well. Large cap financial stocks did really well. Technology stocks did fine, just didn't do great over that period of time compared to other things you could invest in. But if we look then at the second quarter, same three things you could invest in, you can see that financials actually lost money there in the second quarter. SPY, which is the S&P 500, was still up, but only up 4.5% for that quarter, versus QQQ was up 8 the first quarter and almost 8 the second quarter. So that has continued its strength while everything else kind of took a back seat in the second quarter. A big part of that in the QQQ is Nvidia. So Nvidia, this is a chart looking at the first 6 months of the year, is up 150%. It's gone back and forth on what the largest company in the world is, but it's depending on when you watch this, it'll be number one or number two in terms of market cap. Nvidia has had some great growth the last couple of years, best performer in the index. And because it's such a large company now, it takes prominence in the direction of all the different companies and the indices that it's invested in. Basically, how much Nvidia is the biggest driver of the returns for the first half of the year. If we look, and so I've had clients ask, oh, I don't see NVDA anywhere on my statements. Do we own any of this stock? And the answer is absolutely, you own this stock, and you own the stock in both your large cap US stock, core stocks, also in the QQQ, it's the largest holding there. We also actually have some exposure in international and emerging market stocks because they do have discretion to go around the world. And so when I add all that up, if you were to just buy the market, you would own about 3% Nvidia. And I can tell that from the VT, which is the total world index that you can buy. You would own 3%. That's the size of Nvidia versus the whole market cap of the world. In Illuminate portfolios, we actually have 4.5%. So we are actually overweight this stock, and that's led to some additional returns going forward. Now, we want to be careful not to be overexposed to any one stock. And so 4.5 is a good number. We are watching if that creeps up, if Nvidia does really, really well, and that just keeps creeping up, to 5, 5.5. We will look at ways to pare back our exposure a little bit, because we don't want to be overinvested, like I said, in any one position, because then you're just going to get returns based on what that one company's doing. I have reasons to be concerned of the 10-year outlook for Nvidia at today's price, but over the next couple of years, there really aren't a whole lot of concerns. Eventually, Nvidia is not going to hit their earnings number, and we need to be careful that we're not exposed to some major market downturn when that does happen. So you have plenty of exposure to this, but you also have a lot of other investments within your portfolio. So now I want to look ahead. We looked at what happened in the first half of the year. Let's look ahead to what we can expect the rest of this year and moving forward. So the first thing that I want to make sure everyone's aware of is stocks are currently priced for perfection. This is looking at the Russell Top 50 Mega Cap technology PE, so price earnings ratio, versus just the S&P 500 equal weight. The driver for the first half of the year are those top 50 mega cap tech stocks versus the overall S&P 500. If those stocks underperform, which priced at 83% above what the S&P 500 should be, that is concerning if they start missing their earnings. So if earnings growth continues at the pace that they have been, then there's no real downside. We're not really worried about what could happen. But if something surprises, it is likely to be on the negative side, and that we have to be prepared for some volatility and possible drop, especially if it's the mega cap tech that don't hit earnings. And so it's more of a reminder that The things that we know to be afraid of, to be priced in, things like interesting election coming up, or geopolitical events that we are all aware of. Those things are already priced into the market. That's not going to be driving major downturns. What's going to drive major downturns is a surprise that no one sees coming, that's not priced in at all. That's what we need to be positioned to not lose your shirt in. So let's take advantage of a bull market that things are great, but let's also not be overly excited and just pile a bunch of money into these mega cap tech stocks at a really high price, thinking that nothing's ever going to go wrong just because we don't see it. So just a reminder, we want to be balanced. We don't want to be fearful, but we also don't want to be overly greedy when things look really, really good, because that's when you can really have some problems. One thing that I'm looking at and continue to track is the US dollar. So this is a chart of the US dollar index. This is showing the green line is just the dollar, around 100 long term is basically a reasonable number. This is just comparing the US dollar strength versus other currencies that exist. And so when the prices are low, when the US dollar index is low, definitely below 95 or 90, which you could see happen in 2021, that means that other currencies are stronger. Now, there are long-term effects, but I actually want to zoom in just on the short term for this discussion. If you were to take this chart that you see here, so you can see that the bottom was in early 2021, the peak was in 2022, and then you had it drop back down. This is inversely correlated. The dollar index is inversely correlated to short-term movements in the stock market. What that means is as the dollar index bottoms out and starts to come back up, so the dollar becomes stronger, which you can see in this line from 21 to 22, that is generally negative for stocks in the next 6 months. So as the dollar moves into a stronger position, US stocks tend to underperform. Then when they peak and come back down as the dollar is weakening, in the short term, US stocks tend to do really well. And we can see that if you just think back to the different time periods. So this bottomed out, around the middle of 2021. Well, if you look at a chart from middle of 21 through the end of 2022, which is right about when it peaked, that was a horrible time for both US stocks and bonds. One of the worst time periods when you look at a diversified portfolio. Then that peak happened in 2022 and then has dropped substantially and then kind of flattened out. That has led to one factor of US stock market strength, that we've had some great returns in 23 and so far in 2024. So this is something that it's not the end all be all. It's not the only thing that matters. We're also only talking short-term trends, but this is something to be aware of as we look ahead to the future. It's, I would say, at a 104 number, we're at a pretty neutral state. And so it's not significantly strong, but also not really weak. If you see some major change where it becomes really strong or really weak, I would expect to see some short-term stock market movements. And we just need to be aware that that exists. And that's what we're here for, is to watch the stuff like this. So just wanted to give some education on how the US dollar strength affects US stock markets in the short term. And then kind of lastly, I want to talk a little bit about commodities. So the conversation right now is about the Fed's going to lower interest rates and that there are signs of weakness, which I absolutely agree. The labor market looks like there are some cracks. You've got unemployment, jobless claims picking up. You have some additional just economic forward-looking data, leading indicators that aren't super strong. And so in the short term, I think it's reasonable to expect the Fed's going to lower rates a little bit, and that there's a reason to be concerned about a recession. That being said, we are not out of the woods any way, shape, or form over the next decade for inflation being fully under control. Inflation is still something we need to be aware of. And one factor of this, it's both a part of it and also a byproduct is commodities. So one thing that we need to be aware of and looking for maybe even some additional exposure in the portfolio is into commodities. So in general, commodity prices move in what's called a super cycle. So we're not talking a normal business cycle that may be 5 to 7 years from peak to trough and back to the peak. We are talking 10 to 20 year cycles. And for the last 15 to 20 years, we've been in the downtrend of commodities overall. But in the last year, you have seen commodity prices really pick up, and there are a lot of signs that moving forward, if we look over the next decade, that commodities are an area that investors around the world are underexposed to. And so we just need to make sure that you're well prepared if we are at the beginning stages of a commodity super cycle. And so a commodity super cycle will lead to more inflation, because if you have higher prices for all the inputs, that leads to higher prices to consumers. Once inflation expectations go higher, now you have even more inflation. And so when you have this cycle, it's kind of a reinforcement of the whole process. So this is looking at some key commodities so far this year. So we've got at the peak, the best thing to be invested in commodity wise this year was in silver. That's up over 30%. Copper is up 18%. Gold is up 17%. Crude oil prices are up 15%, and natural gas is actually pretty flat. It's actually down 0.65%. Even though these prices are up and they're up higher than the S&P 500 is so far this year, we want to make sure that you're well positioned the rest of this year and moving forward. And so we did add a little bit of energy stocks earlier this year, and I think that's a great place to get some nice returns. If you look at energy stocks in the market compared to energy stock position in the general economy, not just the stock market, energy stocks are underrepresented in the S&P 500 or an index compared to the size that it is in the economy. And so just to match economic growth, we want to add a little bit more to energy stocks. We also do not want to sell out of precious metals, and actually arguably want to increase a little bit with gold and silver. You've had gold for years. If this is a commodity super cycle, gold could go up quite a bit from here. And I think investors as a whole are underweight in precious metals. And then from an industrial metal and minerals, these are very important pieces of the economy. If we have a recession, the prices will come down for silver, copper, uranium. That just gives us more buying opportunities. Again, if we're looking from a long-term perspective, silver is both a precious metal, industrial metal. Copper is something that you've not had exposure to. It's done pretty well. It has come down a little bit from the peak on where it was earlier this year. But as we look at electrification and just fixing our electrical grid, copper is going to be a key resource needed. Again, and also with chips and the AI technology, copper hasn't moved enough for where the kind of world economy is going. And so having some exposure to copper, I think, will be very important addition to the portfolio. I think we've had uranium as a piece. That's something that should continue to be a part of the long-term portfolio. It's still underpriced relative to the future demand. And there will be a point that we pare back a little bit. Uranium, we did a little bit earlier this year and could do it again if uranium does really well. But all of these areas, again, I would argue are underrepresented in general investment portfolios and arguably in our portfolios as well. We've already taken steps that direction. But as we look through the rest of this year and moving forward to 25 and beyond, we will add more to all of these areas and maybe even more inflation protected securities, real assets, things like that. So I know this is, maybe a more technical conversation, and happy to go in a little bit more depth if you want to know more about just the super cycle and where things go. But I think it's really important to be prepared for anything that could happen. And we are positioned really well to protect against if a bull market continues, you're going to make money. If we have a recession, we know exactly what to do. You've got enough money in bonds. We're locking in bond prices at a pretty high interest rate. Inflation is something that we want to make sure that you are well positioned for, both with stocks that do tend to keep up with inflation, earnings pick up, but also direct inflation hedges and areas of the economy that are going to continue to grow. So with all that, that's the end of our second quarter slide deck and investment review and outlook. I would say, we are going to see as the summer continues and we go into the fall, more and more conversation about the election. The market is currently priced in that Trump is going to win. You can see that because it didn't really move with the current discussion about is Biden going to stay in the race. Stock market didn't really move. Bond market didn't really move. That means that's what the market is predicting. If that were to change dramatically as we get closer to the election, whether that's polling results or anything else, that's going to be volatility in the market. But historically, for election cycles, you do have some volatility leading up to the election. Once it's pretty clear who's going to win, volatility goes away, and you want to make sure you're well invested in stocks for the end of the year, no matter which party wins. So we're going to make sure that we continue down that path. We're not looking to sell. I am concerned that stocks could drop at some point, but we're not going to sell out of a bull market just because we're afraid of getting some returns. So with that, happy to talk a little bit more. Let me know if this was helpful, if there's anything else you want me to dive into a little bit deeper, and I look forward to talking to you next time.